Why is that an appropriate entry and exit strategy in this situation?
Sorry, what, Jeff?
Why is that entry and exit strategy appropriate in this situation? In this style of opportunity, why is that entry and exit strategy appropriate?
Because it's a momentum scenario.
Correct. Correct. That's exactly right. Because it is a situation where we identified off of the catalyst that it broke the current range that it was trading with an increase in volume, and there should be momentum components to this trade. So anytime that things are breaking out of ranges with a momentum component to that trade, the 2-minute high low trails are appropriate. Not every time, but when you have that specific scenario, they are appropriate.
That's right. So that's why I'm using that system in this kind of scenarios. Later, I'm gonna show, because this is algorithmic, uh, an alternative way to, decide entry points, stop placements, because the goal here is to react and execute as fast as I can when a headline hits the tape. So I'm going to take some time here because I think this is one of the most important slides in this presentation. The edge, not only in a breaking news trading style, but the algorithmic trading style itself for breaking news. We have very well identified sources of edge in this style and this type of execution. And if we can identify those sources of edge very well, we can do, uh, a stacking edge process, a concept that Jeff has been explaining very well time ago. Stacking edges. If we know where the edge is, and if those situations have multiple sources of edge and we can identify them very precisely, we can maximize every single one. And in this kind of trading, both breaking news and the algorithmic execution part, we have three sources, very well defined sources of edge. The first one, the analytical one, having a comprehensive methodology for identifying and filtering price sensitive keyword permutations maximizes expected value because we are going to participate only in the high probability scenarios. And we are going to cut noise by understanding the way the news sources tend to post or release the information and which of those press releases actually generate volatility and have been generating volatility in the past. So analytical edge, informational edge, having news sources that deliver headlines in microseconds with precision is critical for faster execution. The technological edge, and this is the algorithmic part, the analysis, the filtering, and the execution made by an algorithm is the optimal way to evaluate large amounts of information and execute orders in seconds on or even less, giving the opportunity to capture early prints during breaking news situations, maximizing the risk reward ratio of those trades, therefore, the expected value of the trading system. And all the effort that I'm putting on this program is for maximizing these three sources of edge. How this program works, and I'm gonna make a very simplified explanation of the program because behind the scene, the technology and the coding skills are, are advanced. So I'm gonna be very concise on this explanation.
Roberto, did you have coding skills when you started this project?
Yes, sir. Not that advanced, but
Yeah.
I had at the time.
You had basic foundational skills, not basic skills, but foundational skills.
Yes, sir.
Great. Okay.
So this program was coded using a thing called parallel programming. In simple terms, there are two programs running at the same time, a server program and a client program. I'm gonna explain this very carefully in order to be understood. So the server program is the one that has direct connection with the news source app. In my case, right now I'm using the Newsware API. So this program is the one that is filtering. First, it's receiving the headlines, and then it's filtering, categorizing, and capturing the tickers associated with those headlines in real time. When the server program identifies a potential prices sensitive headline, it communicates with the client program. And the client program is the one that has the direct connection with the API of my brokers, of my broker, in this case, Interactive Brokers API. So this program makes the position sizing calculations and transforms both the ticker and the category variables into executable orders. And then, of course, it communicates with the API of the broker and put the limit order for the entry and the stop order for the risk, all in an automatic process that is made in seconds. Actually, the program is taking right now between 1 to 3 seconds to identify, filter, and execute all those processes in 1 to 3 seconds.
Yeah. So there are a lot of things that we could get into really quickly, but can we jump forward and then maybe we'll have to do another entire discussion about this? Maybe this is a good place
Yes,
for Garrett's meeting or something like that, but let's jump into the trade.
yes, sir. Real quick before the trade itself, how the orders are placed. The long entry point is the point of reference is the previous bar, 1 minute bar.
Yep.
So this is the calculation. This is after a historical statistical study, 0.6 ATRs from the previous bar high for longs, the opposite for shorts, and the stop placement at 0.1 ATRs from prior bar low. Just for understanding how this program places the orders once the headline has been filtered and processed. The trade itself was in KFC, Kraft, merged with Heinz. They are the third largest food and beverage manufacturer in North America. At the time of the breaking news, the ARBOL was 3.5, ATR 0.8, average volume very high, liquidity 11 million shares, third flow 232, gap minus 0.98%. Another interesting intraday fundamental here, institutional ownership 83.71%. The
Okay,
catalyst,
really
yes, sir.
quickly, because we do have a special guest that just joined us. Special guest, can you go ahead and introduce yourself? Maybe you are, sorry, go ahead, Roberto.
Perfect. So the catalyst itself, real quick, I have a process to analyze these kind of things. That's why I have a lot of, keyword permutations because I I do this exercise when I've been programming this software. So the catalyst was a sale of the infant food brand. Why this catalyst was important at the time for the company, a potential inflow of plus 70 million. They were divesting from a low growth business unit, misaligned with the company's strategy, potential additional buybacks or debt reduction programs thanks to
So,
that sale.
yep, I wanted Justin to come in here because Justin's one of the best at understanding dynamics like this. So, Justin,
Hey
really quick, because
everybody.
we're so happy to have you. Thank you. Justin's running another mentoring. I've been in Justin's mentoring meetings before. He's talked about things like this previously when we have situations like this. And essentially, what I'm hearing Roberto talk about with this is you hear a company that has not been doing well in certain businesses, and then they are exiting that business. Justin, when you have been trading like that, and you hear a company is exiting a not super profitable business, what happens to the company typically?
You go long.
You go along. That's it. I love that Roberto has all of this stuff. But the reality is, you can. This is a great example because Justin's in here, and it's like I'm going long. And where's your stop, Justin?
The unchanged price from the news.
Thank you. You're going long. Your stop is the unchanged price from the news. Where are you expecting this to go?
Breakthrough high of day.
And then
And more.
where?
2 ATRs, 3 ATRs, gap up.
Correct.
Depends.
Exactly. Like 2 ATRs is a minimum thought, right?
Sure.
Yeah, like you're really putting yourself in a position where there is a 2 minute bar trail and there's a very technical way to do it. But just being a trader, how great is this that you can say, I think maybe this has a chance to go to a 2 ATR move, right? This is
Yeah,
a big.
and I'm big on using multiple exit methods. So, the momentum piece could be the 1 minute trailing stop, the 2 minute trailing stop. Another piece could be a hold below the 21 EMA. And another piece, you could hold indefinitely to that unchanged price if you think it's a big enough catalyst that could cause like a multi-day run or short squeeze.
But this is where you can get these very discrete catalysts that can really be super interesting because what ultimately kind of trade is this? And just because we don't have time, it's a changing fundamentals trend trade. You are basing it off of the idea that this is a changing fundamentals trend trade. Why are the fundamentals changing? Because the company is divesting from really not great businesses so that they can go and ideally what?
Focus
More
on their
profitable
strengths.
ones.
Exactly. They can be leaner and meaner, right? They dropped that extra 5 pounds that everybody was needing them to drop. They went to the birthday parties and they saw friends they hadn't seen in a while. Their friends went home and were like, "Oh man, like that guy needs to lose 5 pounds." Well, he finally lost 5 pounds, right? Next time he goes to a birthday party, everyone's gonna be like, "Wow, you look great," right? Like that's what's happening in these in these companies. And there is a big change that occurs when the management has not been very aggressive at exiting unprofitable businesses. And it's like they finally give it up, and it's just like, this is great. This is great. And that can change the dynamic of the way the company is viewed. We're going to wrap here today. Justin, thank you for helping people understand this really straightforward catalyst. Roberto, I love the fact that you're approaching it from a quantitative perspective. I'm sorry we don't have more time, but let's all get ready for the Fed. Let's take a little minute to relax, and let's give ourselves a little bit of a thought process about how great some of this type of trading can be. All right? Thank you, everybody.
Yeah, nice job, Roberto. Roberto is one of my best students ever, and this playbook looks really top notch. So good stuff, Roberto.
Thanks, guys.
Network. I'm Oliver Rennick.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time, and we're coming to you live on the floor of the New York Stock Exchange, where you can feel the anticipation, excitement. It's Fed Day, and everybody in a moment, we're here. The decision is imminent. We're starting to hear no change, waiting for confirmation and watching how markets may move. Right now, we are seeing the Dow Jones Industrial Average up 135 points and the S&P 500 up 33 points. Again, I'm hearing some whispers of no change, but we're waiting for that confirmation. In the meantime, we're going to have conversations about what's going on. I mean, the premise is that the Fed will pause. There's just too much uncertainty, whether it's tariffs, inflation, labor, and we've gotten the confirmation unchanged. So as expected, the Fed leaves rates unchanged. You still had the 100 basis point cut over 3 meetings. The last particular meeting was a pause. So right now we're going to watch to see how markets react here. We're seeing the Dow up 186 points, so it's creeping higher, had been up about 126 points, and the S&P is also creeping higher at the moment. But we're going to have a lot of language to discuss about what the Fed does in the future. So here you go, the S&P 5651, that's up more than 0.5%. The Nasdaq's up a full percentage point, basically at 19,672. The Dow gaining 0.5%, and the Russell up 0.5%. Oil and gold both higher. Now, gold had been down a bit and now has turned into the green. Had been down about $2. Now it's up over $4. Oil's at 67.12, not too far off of where it had been. And the 10-year bond yield has fallen. It was at 4.32. And now it has dropped to 4.29. Certainly that is notable. Let's bring in Kevin Hanks, co-host of Fast Market here on Schwab Network. We're starting to get some of the news trickling in. I mean, first and foremost, the bond move is pretty big. Right at the top, before the show started, I wrote 4.32%, and now it's at 4.29%. So that's first and foremost the first thing that people will definitely be watching. What are you watching?
Here's why that is, Nicole. The Fed slows the Treasury runoff, or QT, to $5 billion per month. So a slowing in the quantitative tightening is why bonds are moving. I think that's why you're seeing the market reaction as well. Though they didn't move on rates, that is a dovish move by the Fed. Christopher Waller dissented on the QT decision. I see a fair amount of changes in some of the wording, like you mentioned, but right now, at least for now, the headline is no change, and the headline is slowing the quantitative tightening to $5 billion per month.
And we're seeing that they're going to be attentive to the risks on both sides of the mandate. The mandate, really, the Fed's mandate is really to have inflation and also full labor. And so these are the two things that they're watching to keep labor intact and not have high inflation. They have seen the CPI, PPI. There were some components that folks said maybe the PCE could come in a little hotter on the next round. And that may be the reason why definitely no one was saying a cut today.
Well, exactly right. They didn't guide to it. The Fed funds futures didn't show it. The question is, when is the next one coming? It'll all be about the dot plots and how they see the economy going forward. Here's what we want to know from Jerome Powell and the Fed. How many and when are they starting, right? If they're going to start lowering interest rates, is it going to be June? Is it going to be 3? There's the question. Right now it's set at 2, and it was later in the year, as you know, but the Fed funds futures have moved much closer to that June meeting. The percentage is getting high. So that's what the answers that we're going to see. We're going to learn about, obviously, the dot plots, the GDP, inflation, and unemployment expectations. We'll see what those come in the dot plots. Are they going to mention tariffs? They did mention uncertainty around some things, some uncertainty around the economic outlook. That's some of the red lines that they put in the statement. And then, well, again, we want to know the number of rate cuts. And then they answered one question already. The QT of the balance sheet cut to $5 billion a month. There's your first dovish indication by the Fed. Nicole?
Yeah, what's interesting here is, Andrew Brenner, when I was speaking with him of Nat Alliance, he thought that the Fed was going to play somewhat of a hawkish tone today and not sort of allude to more cuts to come and we're ready to cut and sort of give up the card and play it close to the vest and not say we're doing 2 or 3 cuts this year. He, in fact, thinks 2 or 3 cuts is what we're going to get. That's what he thought. So, right now the market reaction is different than, if they were going to say, hey, we're not doing any cuts. But it looks like they are on the middle of this because they said uncertainty has increased. They did raise the core inflation outlook to 2.8% for 2025. That doesn't say cut at all. As I just wanted to peek and see if we're still at 4.29%. Any final thoughts here?
Yeah, they raised 2026 from 2% to 2.2. So slightly higher levels of inflation. Remember, this is a snapshot, Nicole, of right now what they think. And so some of the inflation was running hotter based on the consumer sentiment. Is that what's creeping into these numbers? Because the hard data, wages, GDP, CPI, PPI were all lower than expected. Maybe they think the rate of inflation, because of the potential for tariffs, the rate of inflation will slow. Because that's why they're raising those numbers for 2025 to 2.8, 2026 to 2.2. So we'll see how that plays out over time. But like I said, and Jerome Powell will reiterate this, the dot plot is a snapshot of right now, Nicole.
Yeah, and the economy expanding at a solid pace. To your point, 2.8 on inflation for this year, 2.2 next year, 2% in 2027. And you know what's interesting, Kevin, I'll leave you with this final thought. I know you got to get back to work there at the CBOE. Remember that statement, risks are roughly in balance. They took that statement out. So the uncertainty around the economic outlook has increased, so they cannot no longer say that statement. All right, Kevin Hanks, great stuff. Thank you so much. Wonderful to see you there at the CBO. Let's continue this conversation. Michael Green, Portfolio Manager, Chief Strategist at Simplify Asset Management. Tell me some of your thoughts as we're getting the breaking news here on the Fed, leaving rates unchanged, but talking about the economy, the uncertainty. Your thoughts?
Well, I think you nailed it when you highlighted the phrase economic uncertainty has increased. They had to acknowledge that. This is a very slightly dovish guide, as you can see in the reaction in the rates market. But it reflects almost everything that most people had been expecting. So I don't actually think that this is that meaningful. We're seeing muted impacts in rates, 4 basis points, while certainly not to be ignored, is basically unchanged versus yesterday. The equity markets are rebounding slightly in response to, again, that perception. We're really going to have to wait and see what Powell talks about. I think his emphasis is going to continue to be on improvement in inflation and expectations that they will move towards their target. I do think the points that were raised by the prior guest, that the uncertainty around tariffs in terms of whether that impacts prices on the short term, and then the other component that'll be interesting to see Powell emphasize is his use of the phrase market-derived prices as compared to imputed prices. That continues to be a key driver of the persistence of inflation. If Powell emphasizes that, I would actually interpret that as a very dovish statement that suggests the second half of the year could see more cuts that are currently priced in.
you know, it's interesting because I had a guest on talking about a hawkish tone, and you're talking about dovish tone, and that's why maybe the market really isn't selling off, right? Because if people started to get the vibe that, you know, they were just not going to do anything or even raise rates at some point, then you would have seen a different market reaction. How do you explain the market reaction here? I would say that stocks ticked slightly higher, and bond yields dropped for a moment but have crept back higher.
Yeah, I think that's right. I think that we are basically unchanged on the news. It broadly met expectations. Again, I think we're going to have to wait to see what Powell emphasizes. If he continues to emphasize improvements in inflation and growing uncertainty in the economy in his speech, that's really what the market's going to key off. We have a long history of this. The statement is designed to be as milquetoast as possible in most situations. It tries to accommodate all of the individual participants. But what we really care about is what Jerome Powell is thinking about, and he's not going to tell us that for another couple of minutes.
I mean, are you worried about the economy expanding at a solid pace? Is that too much, too fast for the Fed?
Well, again, I think the question is what is driving the underlying components? The question that I want to be asked, that I know will not be asked during the Powell press conference, is the market deterioration that we're seeing in credit metrics, everything ranging from credit card delinquencies to auto loan delinquencies to the growing awareness of the challenge that's been created in the FHA and the subprime housing sector again. These are areas that I would be surprised if they are addressed in the meeting, but they're the areas that we should be paying attention to as we think about how does the economy develop going forward.
4 Fed officials expect no 2025 cuts versus there was 1 in December. So whoever thought a cut may have been merited has changed their mind. And so now you have 4 Fed officials that say no cuts in 2025. Your thoughts?
My immediate reaction to that is somewhat to be expected given the residual seasonality that I was highlighting in inflation. We have a repeating pattern of inflation being elevated on a seasonally adjusted basis in the fourth quarter and the first quarter. Unfortunately, that is a byproduct of unexpected seasonality that was introduced by the pandemic and by the Russian invasion of Ukraine. That means that our seasonal adjustment numbers are creating a condition under which we should probably actually have very low inflation again this summer. I would expect them to reappraise their opinion just as they did as inflation kicked back up again, driven primarily by that non-seasonal factors in the fourth and first quarter. So my expectation is they'll change their mind.
And then just quickly, I mean, what do you do with the portfolio here today now? I mean, people always want actionable advice. Quickly, Michael.
Yeah, I think the most important thing to remember is that with stocks down, there's pressure that's being placed from the option world, primarily from income enhancement strategies, things like call overwriting or put writing. That's created conditions under which the dealers are basically forced into a more volatile trading position. A lot of that goes away on Friday. And so I expect that we're going to get some short-term relief, and then we will find out how the economy develops. That'll determine the longer-term picture.
Yeah, all right. Well, they did actually raise the 2025 unemployment forecast. They cut the 2025 GDP projections, and we'll continue to follow all of this breaking news. Michael Green, good to see you, portfolio manager, chief strategist at Simplify Asset Management. Thank you, friends, so much for breaking this news with me. Right now, the Dow's up 229 points, so you are seeing equities moving higher. Bond yields now back lower, right? We were at 432, now we're at 429. And the 10-year bond yield. The VIX is taking a bit of a breather here. That's in the red. That's moving lower. We'll be right back with much, much more. We'll bring in Jack Ablin from Crest Capital, and we'll continue to break down this Fed announcement. And at 2:30, we will hear from Jay Powell himself. That is the press conference. Of course, he has a prepared statement followed by the Q&A, which can sometimes be really exciting. Schwab Network will be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the Watch List. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange, breaking all the news from the Fed, the Federal Open Market Committee, its decision, its members of the committee, and of course the press conference coming up at 2:30 p.m. Jack Ablin is with us, Chief Investment Officer, founding partner of Crescent Capital. Thank you so much for being with us. We got the unchanged. That was pretty much expected. We're still seeing, it looks like, 2 cuts for 2025, but there are some nuances within the statement. What stands out to you?
Yeah, I haven't had a chance to review the statement. I'm sorry, but what I do know is that the Fed's job is still complicated by the fact that inflation expectations are still rising. One of the things I want to look at are the dots. They point to 2 rate cuts rather than 3, which the Fed funds futures would have suggested. And all in all, I think it's really no big new news here.
Right. They're also going to slow the central bank's balance sheet reduction. They're doing that. You're right about the 2 cuts that they have priced in for this year. You have 4 Fed members who actually see and expect no cuts for 2025. This as the Fed took a look at the PCE core inflation, and they expect that outlook to rise in 2025 to 2.8% from 2.5%. Inflation remains somewhat elevated. Economic uncertainty has increased in the economy, expanding at a solid pace. Is that too much for the Fed to bear? Maybe they can't do their cuts.
Well, I think that's part of it. And the other part of it is if you look at the University of Michigan indicators of what households think inflation will be next year, it spiked to 4.9%. That's up from about 2.5 in November. So I think that's also really getting their attention. And we can't have, I know we can't have an environment of Fed rate cuts if expectations are on the rise.
Yeah, what's also interesting, at the same time that all of this that I just read to you, unemployment expected to rise and the GDP growth expected to come down. Your thoughts there?
So worst case scenario for the Fed is stagflation. We're not calling for that, but if you take just the simple policies at face value, cut government spending, well, that takes about 0.5% out of GDP because in general, government spending adds about 0.5% annualized per quarter, and then take tariffs. And even if it's just a one-time price shock, that could spur some other inflation. So again, at least those arrows are not pointing the Fed in a direction of rate cuts anytime soon.
Understood. So at this point now, markets are moving higher from where we were right before the Fed made its announcement. What would you suggest to investors who are looking at their portfolio and feeling the pain of the last 4 weeks? In fact, for tech especially, what do you tell them?
Yeah, so certainly when you have a combination of uncertainty and expensive markets, it's not a surprise we're going to see a sell-off, particularly in U.S. large caps. What we're seeing, though, is not every market is expensive and not every market is falling. We've seen now since probably February a divergence between world ex-U.S. and the U.S. And so you've got international markets are incrementally cheaper. They continue to move in the right direction. This suggests, anyway, we're not looking for any kind of a worldwide pullback at this point. but we do want to check credit conditions at home. So I guess our bottom line is remain diversified. Obviously, you want to check your unrealized gains. You don't want to take unnecessary gains. But if you can diversify into relatively cheaper markets like international or even some small cap, not a bad time to do that.
Yeah, I noticed you had small caps on there. You said small caps are relatively cheaper than the large cap counterparts, and that the top third of the folks responding as far as confidence, the top third earners, I guess, or net wealth, are in a different position. Those top third income households, let's see, they show their confidence fell sharply, because I was going to, for a second, I thought they were doing something different than the other prints. So, because for, a lot of times the luxury group is somewhat resilient, but in this that you're showing me here, they are not so much. But you are saying that they can go for small caps. Those seem to have some value for you. You also brought a few stock picks. These may, and you said you're watching for picks that are tariff insulated. Very interesting. Tell me about those three names.
Sure. So let's start with HCI Group, ticker symbol HCI. It's property casualty insurer, is focused primarily in Florida, remarkably. But it has right now the catalyst is they have a technology platform that they're looking to spin off, either to a strategic buyer or to shareholders. Next is Concept Therapeutics, CORT, C-O-R-T, is the ticker. That is a pharmaceutical company, generally develops psychiatric medicines, and they've been successful. And then lastly, Innovative Industrial Properties. So this is really just this company ticker IIPR. They own and develop and lease industrial real estate. So if you're thinking about the trend in reshoring, it could be an interesting play.
Right. All right. Thank you for that. IIPR, CORT, and HCI. How many cuts do you think would be appropriate for the Fed to do? I mean, the plot shows 2 cuts this year. What do you think the Fed should be doing?
Sure. So one of the research pieces that we published today is this notion of, what you had just pointed out, the top 10% of income earners. So if you think about just as 10% of households, according to a Wall Street Journal report a couple of weeks ago, they account for half of all spending. If you focus on discretionary spending, that by and large, the majority of discretionary spending. And so it's very important to see what this group does. So if you break it out, this 10% category accounts for a third of our GDP. And this category, this group really relies on what we call the wealth effect. What is the value of their stock portfolio? Do they feel good about it? Well, probably right now, no. What about the real estate? Well, the real estate values are probably holding up okay. And what are their current job security, job prospects? And that's pretty good. So we're not seeing any tangible evidence of them pulling back, although we have heard from Delta and other airlines a couple weeks ago suggesting that bookings for leisure travel are off a fair amount. But we're going to really pay heightened attention to what this 10% group does, because it's going to have an outsized influence. So what does that mean? It means that if they do pull back, we're going to see economic growth regress in some way, and that could pave the way for rate cuts later this year.
All right, Jack Ablin, thank you so much. It is great to see you, Chief Investment Officer, founding partner of Crescent Capital. Thank you. Coming up, we're standing by for Jay Powell's opening statements. We'll be bringing you that, of course, live. We'll hear from our Fed chair all about today's move and also the path forward.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab. Schwab, a modern approach to wealth management.
Welcome back to the Watch List. I'm Nicole Petalides. It's Fed Day. There's a lot of hustle and bustle here on the floor of the New York Stock Exchange, where stocks are moving a little bit higher on the heels of the announcement of the Federal Open Market Committee, leaving rates unchanged, but a lot in the language and in the statement. And we're waiting for the press conference, Jay Powell's press conference, that will begin very shortly at 2:30 p.m. Eastern Time. I would also like to have a quick conversation with George Sillis, senior markets correspondent, who's been watching all of this breaking news at this moment. Some of your thoughts on what's going on right now, George.
Well, I think there's a lot going on. It's kind of hard to process it all, but I'll try my best. Obviously, the markets, at least right now, are trading favorably based on the statement. If you look at essentially some of the changes to the Summer of Economic Projections, they're actually quite meaningful in some regards. GDP growth, which was going back to December in their last SEP report, was at 2.1. Now they've reduced it by about 0.4% to 1.7%. And the PCE number also is increased by about 0.2%. So those two figures together point to a potential stagflationary condition that the Fed is giving us. I think at the same time, the Fed is providing some reprieve to assets, and the reason I say this is the meaningful component, I think, is the balance sheet. What they're doing is essentially reducing the runoff of the balance sheet, at least the Treasury side of it, from $25 billion a month to basically down to $5 billion a month. So what they're doing is essentially reducing effectively the runoff, which is now increasing the amount of bank reserves for the banking system. This ideally should be very supportive to longer-term rates. And in fact, if you look at 10-year rates, they're coming down slightly. But more importantly, I'm looking at 5-year rates, which are really the proxy for corporate rates. Those rates have come down. So I think, there's some bads or some goods. I think the balance sheet, the reduction in the runoff is a good sign for assets and interest rates. So they're trying to offset the needs for higher or lower long-term interest rates. But they are maintaining their federal funds rate. In fact, they didn't adjust their guidance at all for the next 2 years. In fact, the long-term federal funds rate since their last SEP report going back to December, that hasn't changed. So they're expecting still 2 rate cuts, and that's to deal with some heightened inflation expectations. But at the same time, they're trying to get longer-term rates. At least they're indicating they want them a little bit lower to help alleviate some long-term financing concerns.
The stagflation is a concern, right? I mean, if you have projections for inflation to rise and GDP to come down, unemployment, they raise that projection as well. What happens to the stock market in a stagflation environment?
Well, that's the thing. If the growth numbers come down too much, then that's going to affect corporate profitability. But on the other hand, you have to consider inflation. Consumers pay it at the end of the day. Producers, especially those that have pricing power, actually benefit. So, depending on the level of GDP growth, that's going to make a difference in total corporate outlook, corporate profit outlook. But ideally speaking, it's probably going to be slightly bullish for corporate profitability if there's some heightened inflation. And it could be, and this is something you have to consider because we have to mix in what's going on with the Trump administration, but the tariffs may actually, create a situation where there's more production being developed here in the United States. That's going to be short-term inflationary, but long-term, it's probably going to be more supportive for the labor markets. And in fact, the labor markets, in terms of the unemployment rate, only ticked higher based on the Fed's SEP report now from 4.3%. This goes back to last December to now 4.4% for 2025. So not much meaningful increase in their projections for unemployment, but I would say a slightly more meaningful decrease in their GDP outlook for the year.
I wonder if we can hold on to the gains that we're seeing here. I mean, we were higher for stocks than we are at this moment. We've come off the peak. But what's interesting is we're at the lowest point for bond yields. We are now at 4.27%. A final quick thought before Jay Powell comes to the podium.
Yes, in theory, that should be the case, just based on the mitigation or the reluctance to run off that additional $20 billion per month on the balance sheet. So that should be supportive of the long-term bond market.
Yeah, understood. I mean, the uncertainty has increased. They are prepared to adjust as needed. And here he is, our chair, Jay Powell, at the podium, Washington, D.C. Take a listen.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, and as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or as the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard.
Howard Schneider with Reuters. Thanks for your time. So two things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby. Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens some higher inflation over the next year. Must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration, and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros of the Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth when you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation?
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those two kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly, and so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
pandemic? Yes, during the
because
pandemic.
you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really shows significant problems like that.
Well, just to follow up, yesterday, the UCLA...
All right, welcome back. We're listening in to our chair, Jerome Powell, speaking at the podium in Washington, D.C. after the Fed leaves rates unchanged. Did actually slow the pace decline of securities and actually did a few moves that George Silas, who I bring back in now for this discussion, and I have been talking about. I mean, we heard from there. I mean, it really seems like the labor picture is steady Eddie. I was pretty comfortable with that. The uncertainty really lies on tariffs and inflation and what the Fed does next. The dot plot still shows 2 cuts. Markets moved to session highs while he was talking. So we're at the highest point of the day on the S&P 500 now. George, your thoughts?
Yeah, I mean, I think they address, or Jerome Powell addressed the primary concern that people have is tariffs. So, you talk about tariffs and immigration regulation and fiscal policy, and effectively, he was really a little bit cloudy in terms of their anticipation of what tariffs will do because it's still ongoing, and that might have impacted their change in projections for the PCE or inflation in 2025, as well as the fact that might be the issue associated with their projection of GDP growth being down a little bit. But nonetheless, I think at the end of the day, what I deduce from all of this is that the economy is still humming along. They're going to be willing to and able to react to any changing conditions. And in fact, he talked about how, there's no hiring, there's not much hiring going on, but there's not a lot of layoffs. But, once layoffs do begin, that they can accelerate quite quickly, but they'll be ready to react. And I think that's why maybe they left their policy stance at potentially 2 rate cuts this particular year, to give the market some anticipatory expectation that they're willing to act, and I think that's very positive, at the least for the equity markets. I didn't hear too much about the fiscal policy, but I'm sure that what's happening here is with the debt ceiling that's about to become an issue, and then the resurgence of needs to finance treasuries. There's going to be more ample reserves for the banks to be primary underwriters or dealers of those treasuries. So I think that's part of what they're doing with their balance sheet. But it's not necessarily a QE policy per se. They're just getting back to a level where they're not going to run off the balance sheet as fast. I think that's quite meaningful for the markets, at least right now, from a reactionary standpoint that we've seen since the initial statement and now continuing on through the press conference.
Yeah, so they are obviously slowing down the pace of that runoff. They've already ran off more than $2 trillion, he noted, so I thought that was notable. You have the debt ceiling looming, and that may be another reason why they're doing it in this way. And that's something that folks are talking about. And I'll leave you with Mohamed Al-Arian's note where he said, the growth cuts were more than the inflation hikes that they saw going forward, and that the market seemed to like that they're keeping the things in balance here. He wrote, the stock market will like the rate guidance remaining, so basically 2 cuts, and it sort of quells the worries about growth, because people are worried about growth.
Yeah, definitely. Ideally speaking, even looking, like I said, some of those Atlanta, the GDP now figures from the Fed, Atlanta Fed, those were a little bit concerning. Obviously, there's some challenges for consumer sentiment, and Powell did address these, but they're going to be looking at the data ongoing as is extrapolated. But overall, the labor market is relatively solid, and consumers are still spending. But now they're really addressing some potential, or they're getting ahead of potential, some liquidity issues, which I can see as a possibility considering, fiscal contraction, because fiscal restraint actually reduces the amount of reserves that go into the banking system, because all the government spending eventually ends up as reserves in the bank. So I think this is interesting because they're counteracting the restriction in potential fiscal policy with some alleviation in the balance sheet reduction. In other words, letting the runoff lessen, if you will, by about $20 billion a month or $240 billion a year, at least right now, based upon this meeting's guidance.
Right, and the Fed's trying to avoid a rerun of a situation, I'm reading from here, because I was talking about this earlier, rerun of a situation that occurred in 2019 when it was also shrinking the asset portfolio, so this balance sheet. So this is what they're thinking, and this is one of the things that they have in mind. I mean, the final takeaway here, and you said it, they seem ready for anything. Your final thought? We have just seconds left, George.
Yeah, I think my final thought is even though GDP growth for 2025 has come down, it's not in recessionary position. I think that's important to keep in mind. Obviously, they're pricing in some slightly higher inflation, and that's to be expected contingent upon tariff and the uncertainty around that. But irrespective of that, there's no signs right now that we're in an imminent situation where they're in need of an emergency rate cut. But at the same time, they're really trying to address lower interest rates, longer-term rates is what the Trump administration is looking for. I think the Fed is addressing that, and the economy, obviously providing support to the corporate refinancing rates, but at the same time, potentially now providing support to assets. And I think the most important component of that was that $20 billion decrease in the runoff. And so, again, that's, I think, quite meaningful, at least for the markets.
George Silas, thank you. Markets and record right now at the session highs of the day for the S&P 500. We're going to turn it over and continue our special FUD coverage here, where the rates left unchanged, but a lot of innuendos throughout this story in this last half hour. Thank you for being with me. I'm Nicole Petalides. Our coverage continues here. Market on Close next.
Good afternoon. Welcome to Market on Close. I'm Oliver Rennick. Thanks for tuning in.
consistent with our plans and our practices that we published and that we followed since we began this, what is a very successful, rundown of balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we generally say. And clearly, we're not at that level yet, but we're going to be approaching it more soon. It's a common sense kind of that framework.
Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remain well anchored. Would you still say they remain well anchored today? And just to reiterate the well anchored, why hasn't there been a more radical shift to the policy faculty?
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved in much, if at all. They're one reading and the one's focusing on that's higher. The other survey readings and the market-based readings all show relatively well anchored inflation expectations. You would expect that expectations of inflation over the course of the year would move around because conditions change. In this case, we have tariffs. We don't know how big. Some things we don't know, but we kind of know they're going to be tariffs. They tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, we're not dismissing what we're seeing in terms of inflation expectations. We follow that very carefully. When we say expectations are anchored, we're really looking at longer terms, 5 years out. There's really no story to tell 5 years out, either in market-based or current surveys. But we keep a watch. We're not going to miss any evidence that longer-term, medium-term inflation expectations are moving.
Chair Powell, Neil Irwin with Axios. Treasury Secretary Bessent has observed a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, education.
Just show me what I'm sweating. I need to know what I'm sweating. You like, yeah?
Do you agree there's some weakness in the private job growth, and do you see competition as policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving at a healthy rate. And they're all jobs, but remember we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to
Mike's coming in next Tuesday, I hear. Yeah, I'm excited. It'll be great.
right. Trying to get more reps in on my best trades. So now I am doing something new. I'm going to do a video break in correct close in Monday's session, which was a pass 1, 2, 3. This is the really first time at 250. They're going to compare also exiting. So we got kind of different time frames. See it in the 60, right? We're just wedging basically 3 legs down, right? We had 1, 2, and then kind of a half leg, and we closed it low of day. To exercise this trade idea. And I sold the second chance, the failure of the second chance. So opening range, sets up, pushes up, fails, retest that opening range, and which is why I'm 250 and failed. Exercise, or what I learned is back to trades, right? This idea that like trade 1, stacking.
would just shorted here, risk high day, I would have made money. Shorted this, risking high day, would have won. Shorted this, risking swing high, I would have won everything. Now I just tilted that shorted, covered. I don't know what this is, to be honest.
This? You've given it high days. Well done.
Yeah, I know, that's what I'm saying. This one I shorted, covered. Short, covered. Short, covered. Long, lost. That shit was hella chocolate. Yeah, like it was good. It was so much chocolate at the end, but I can't finish it. I see Max's positions. You're scum. No. I gave you one already. You gave me half. I want the other half. What are you doing, Goldman Sachs?
Two.